Hi, this is Randy Finney with the right side of the chart, and this is a late session update for Thursday, August 7th, 2025. Won't go long in this one. I just kind of hit on all the things that have, well, not all, but some of the things I've highlighted recently and what stands out at this point in time. This is SPY, the S&P 500 tracking ETF. Kind of go nowhere. We're still, or back to the top of that gap. We tried to briefly punch above it once, punch a little more. And we still remain, most importantly, we remain below the bearish engulfing candles that were put in on all the indexes, the main ones, S&P 500, NASDAQ 100 last week. That was last Thursday on the daily chart. And also last week printing a bearish engulfing on the weekly chart. So I'll give this market credit. I'll give it some points. They just continue to aggressively buy up the bid. I read an article about it today. All the commercials, the commercial traders, the professionals are just baffled, almost given up. There's just a mentality from retail traders: buy every dip, no matter what the news is. And so, but remember, I don't trade off what is currently happening or what may happen. Trade off the technicals, at least in this particular instance, and that's what I'm giving you. So no change in the outlook there. So you either you have a trading style if you trade off the charts, and that's it. You have a sell signal. Again, as I've been stating, it's not an all-in moment until we take out or any you can't make a strong case to go heavily short until at least we take out the lows that we had last week there on Friday on both SPY and QQQ and or the future. So that's what I've been saying. So that's it. We're back to where we were when I highlighted this backfill the other day. We're there now. Now I will say this: the fact that they punched through there, backfilled the gap, came back down, hit the bottom of the gap, went up, got above the gap, and we're back in it now. Again, I'm just telling you from experience, typically that signs of weakness. It shows that the buying is finally stalling out. Usually, again, not always, but usually once you have a very well pronounced, very obvious and technically significant gap. Again, that gap came right after those bearish engulfing candles. So it wasn't a just kind of random here or there gap. Typically, once that happens and you have that, and then you clearly can get back above the gap after backfilling it right there. There was the backfill on the way back down. So we backfilled it up, back down there. Usually that's off to the races, and we didn't have that so far. But again, we're going off the charts. Right now we have those sell signals still very much intact, so nothing's changed. And we're back to where we were the other day. And again, it was a relatively small move above there. And so that's it. I'll update if there's anything significant until I see us go through here or pop the highs. Anything by more than just ever so slightly. That's the kind of the track record of this market. Pop, make a marginal new high, and then fail it. However, that hasn't happened yet, and it's not my expectation. If it does, I'll address it at the time. If it's anything more than that, I will address that at the time too. QQQ, a little bit above the gap there, still falling well below the previous highs. Oh, let's look at the equal weighted. I've been watching that. I've just noticed a deterioration in internals lately. Nothing huge, but kind of the same story we've had for years now. Towards the top, you get these runs, and then it's the Mag 8, the incredible overweighting from those market cap weighted indexes like the S&P 500 and the NASDAQ 100. Here's RSP, the equal weighted S&P 500. And you can see that is yet to make a new high. It actually put in a perfect double top. I think I covered this recently. Stalled out exactly where it did back in 2024 before that big drop. And just like everything else, it recently took out. You had this big bearish rising wedge. I had, various trend lines I've showed you the other day. I had it on the small caps and RSP. These aren't fib fan lines. They're just they're not parallel, but similar trend lines in decreasing in slope. So you had the strong rally off the beginning. We went long. We milked the bulk of that rally up there. Then we kept going up, but momentum has been stalling. And again, that's what these momentum indicators tell you right here. That's why you'll see them on just about all my charts. So the market's not really going down other than the last few days. It's going up, but it's going up at a much slower rate. And again, that's what divergences are all about. Be they bullish divergences that help identify a bottom, or a trend change, after a correction or bear market, or bearish divergences, which you get in an uptrend, in a bull trend, but it just shows that momentum's waning. So I wanted to point that out on RSP. And then you can also look at QQQE if you want to see what the equal-weighted NASDAQ 100 looks like. And that is actually back now below where it was. And again, I'm just trying to, kind of gauge and show you the fact. Now, you could go through, and I do it all the time, all 100 components of the NASDAQ 100. I'll even glance all 500 of the S&P 500 and to look at market breadth. And the way I do that, something I came up with years ago, I call it my real-time market breadth indicator. Anytime I type in an ETF, or whether it's an index ETF like QQQ or SPY or a sector ETF, it loads all the components for me. And what I do is simply sort them by the up or down column. So on any given day, I can get real-time breadth to the very second on any index or ETF or sector ETF that has these components. And so what I do is I scroll down. So here's the NASDAQ 100 today, for example. I click on the last green one. It's technically flat, so it's not up, but we'll just click there. And then I got to go a little lower so you can see it down here at the bottom. Let me pull that up a little bit. It tells me, you probably won't be able to see this in the video, 37 out of 100 items are green today, meaning the other way to do it, if you want to, of course, you could do the backwards math, not very hard. But if you go sort them by the red losers, you have 63 out of the 100 red. Now, I'm going to say this, I say it often, one day doesn't make a trend, but it is a trend I've noticed in the last few days. And again, if you want to evidence, or kind of get a click, anytime you want a quick glance, if you don't have this ability to, on your charting program, to sort by gainers and losers in a sector. So the S&P 500 today, you have about 270 are down in the red. What you can do there, again, you can just simply kind of compare, maybe put two charts together, or eyeball, the S&P 500, and then type in RSP, and you can see that, we're seeing the, and even lately, if you want to get a little more granular, you go down to a 60-minute chart and you compare the two. Maybe you plot them on each other. All right, so that's that. Nothing new there. The NASDAQ 100 is still red today. I'm sorry, the Russell 2000, not the NASDAQ 100, that is red now, the NASDAQ 100. But this is IWM. Remember on the 60-minute chart, I covered this the other day, so I don't want to spend too much time. We just put in a divergent high, breakdown, and just a typical run-of-the-mill snapback rally, but we're still very, very much below that bearish rising wedge. Times I like to put up fibs, Fibonacci retracement levels, and kind of just gauge if it was a run-of-the-mill pullback, which that pretty much was, counter trend bounce. So that's it. I went over these charts in more detail recently, so let me get into some other things here for you. Okie doke. Well, let's start with this morning. I got out, the last couple of days I've been highlighting Novo, NVO as a bottoming play. Again, great company, great long-term chart. Recently, as I said, earlier this year, they had gained the distinct title of becoming the largest publicly traded company in Europe, and that was almost a kiss of death when they started running those headlines. But again, 70% drop off the highs to what I call excellent support, long-term dual support. If the market holds up, all the better. There's a lot of there's some uncertainties with the company, but again, the thing about when you read the headlines, it pretty much can't get much worse now. So you have to ask yourself, how much of the bad news has already been priced in? And I'm going to say most likely a lot. If we enter the big major secular bear market that the charts tell me is coming in the coming years, yeah, this one could go quite a bit lower, as will everything. Remember, all ships are lifting a rising tide, and the inverse holds true in a bear market, especially a very powerful one. This is not a U.S.-based company, but they do have generate a lot of their sales from in the U.S. And anyway, nice update today, but nothing big. Not we're far from the targets I gave you, even on the daily chart. But the key is that we're holding some support there, and that long-term support so far. This is a weekly chart that I showed you. This long-term support. All that matters is how we close the week. And with 1 day left, we're looking to successfully defend. That's a reaction. A reaction I define, if you follow me for a while, as one of two things. When a stock is going down and it hits support, and if I'm expecting a reaction like I am here, I define that in one of two ways. I call it my hacky sack or tennis ball analogy, or golf ball, whatever you want to say. You drop a hacky sack onto a concrete floor, it's going to stop there. You drop a golf ball or tennis ball, they're going to bounce. So that either of those are reactions. You're going down. The reaction is, an object in motion will stay in motion until unless acted upon by an equal and opposite force. And that's what's happened there. So we'll see. Again, like any other trade, it's one move on. I told you I'm hunting hard for long trade ideas for you that I feel comfortable with. I'm not the kind to buy Palantir right now or NVIDIA. I'm the kind to get ready to short those, right? That's my style. For the crowd, these more common brand name, blue chip stocks, if you will, Pepsi we've seen, and the other ones we've bounced. Those are the ones that my comfort level is a little higher with. And again, it's all part of a diversified portfolio. Then on the flip side, their nemesis, if you will, is Eli Lilly, and gave that one to you this morning. Gave that to you actually in pre-market. Wanted to make sure to get it out because we were at the bottom of this zone. We were trading right here at I think it was 6. We were at 689, I believe, right at the bottom of that zone. I had hand drawn it in on the chart, and I tried to replicate it here, and we were right there. And so if you took the short there, you're already up about 8%. Nothing huge, but nice for a day. Coming up on that first target again. These were the targets I gave you on the daily chart. And again, it can be both a mean reversion trade. These stocks were trending together. They're both, if you're not aware, Novo came out with the GLP-1 drugs, the Ozempic and Wegovy, and then Lilly was right behind them, kind of copying that formula, going on their heels, and then coming out with Mounjaro and the other one they call same, pretty very similar drugs, slight differences in the makeup of those drugs, but both GLP-1 antagonists, or whatever they call them. Either way, that's a breakdown right there. And again, this is a weekly chart, so barring any big reversal, you're going to close below a very nice, well-defined trend line. So this is, and you also took out this support level right there today in one fell swoop. You took out both that primary uptrend. A lot happened actually. The primary uptrend line I'm just showing you, or this one from late 2020. Yep, that was late 2020. You took out a hell of a support shelf. Look at that. This goes on since the beginning of 2024 down here, right? You took that out, and if I turn off all the lines, you also lost the 200s. These on the weekly chart, I have them up as 40-week simple and exponential moving averages. Same thing as a 200 daily moving average on a daily chart, because there's 5 days in a week. 5 times 40 is 200, and you can see in bull, like most stocks, those define bull and bear trends. You want to buy pullbacks to the 200s or the 40 weeks, and then when they're lost, you want to short it. It struggled, tried to regain it a few times, but now clearly after months of flirting with and trying to backtest and get back above those 40 weeks, you see that big rejection here. So if this stock closes down anywhere where it's at now, or worse tomorrow, which is Friday, the end of the week, then that's a pretty good sell signal there, and you can kind of tuck that one away, if you will, for a while. All right, what else have I given you? Oh, you know what I want to revisit? I gave you the, just about a little over a month ago, lithium stocks. There, it was right here in this video dated June 26. Highlighted like in the lithium stocks, they had just broken out. I'll hit the play button. Let me just mute it here. And show you. So this is that second little cursor is me doing the video. I just muted so I wouldn't be talking as I'm talking to you now. Oh, sorry, that was past. I'm showing you going up to these two target. There's a trend line, and then the next and final target. And so we were just breaking out again there. And so they're good right now, but they already hit the trend line. Kind of took my eye off them. My bad. But again, that's why I throw these charts and all the analysis and the charts out. If you like a trade, take it. No, pick your targets, take mine, however you want to do it. And that's good for about, I was highlighting right there on the breakout. We hit almost a perfect tag of that trend line reaction there, 16% profit, little pullback to the 200. So it actually still looks good. That's why I'm highlighting it today. So you already made 16% if you took it there and sold the trend line, or that first target, you made a little less. I gave you the trend line, and this is the final target, 47. So we've hit that. Nothing goes up forever. It was a pretty extended run following the breakout. We pulled back to the 200-day moving averages, and so far bounce, and we're back to that $43 target. So if we can punch through there, remember we already hit it once. So that what that does to me, the way my trading works, it checkmarked it. We already had it, hit it. So it doesn't mean it's still resistance. We still could get rejected, but it opens the door, increases the odds we'll go through it, whether it's this time around or sooner or later. And we also already checked the trend line, which increases the odds we can go through there. So unless the market shits the bed, soon, which can happen, I'm going to show you something else that I've been watching lately. That can open the door. So if you take it, took it, are in it, want to take it, stop there. An entry here ish with or down to this 39.40 level with a stop somewhat below there, right? That's where I'd have it. I wouldn't hold out for a back test, allow for a back test of the trend line. Why? Because trend lines are downward sloping, meaning every single day as time goes on, they come in at lower and lower levels. It's just too far. At most, where we took it right there on the breakout, which was about 38 and change, then that's a stop at break even if you happen to take it there. So like I said, let me roll into what I'm watching, and I'll show you a watch list I created today. Let me pause the video and pull that over here. Okay, so I put together a new watch list today, and named it BDCs, which is private credit. Those are business development groups. Okay, so yeah, I'm sorry, business development companies. And so most of you have probably heard, if you haven't, well, I know you've heard of private equity groups, right? You've probably heard about how the one red flag that has not been flashing, and I've talked about this, I monitor them closely, are credit spreads. But there have been more and more articles recently talking about what may be masking that. In other words, if you're not familiar, credit spreads are the difference. I don't have a credit spread chart pulled up, forgive me, but it's the difference between what safe haven U.S. Treasuries, Treasuries are considered the risk-free rate of return, because there's virtually no risk. The government can print as many dollars as they want to pay back the debt. So you really have almost a zero default risk of U.S. Treasury bonds. And so credit spreads are the difference between junk bonds, or what are also known as below investment grade, anything below a triple B rating, and what the AAA or times or AA Treasury bonds are paying. And again, credit spreads have been in the past a very good indicator of impending problems in the financial markets, and usually before a recession. What happens? You see credit spreads begin to rise. Those in the know, the smartest people on Wall Street, most of them are in the fixed income markets. I mean, even if they're equity fund managers, they certainly pay attention because the credit market is much larger than the equity markets, and it's usually where you can pick up whether things are hunky-dory in the financial system or not. And so, with that being said, we haven't seen a tick up in credit spreads, but what we have been seeing is a tremendous amount of money, and I don't have the charts in front of me because I've been reading a lot on this. I have articles bookmarked. You can look into it yourself. But basically, so what these private equity or private credit companies are doing, and we'll go back to my list, is it's been growing, outpacing the growth rate of traditional loans. Normally a business, you go to a bank to get a loan. And even for those of you that run a business, you know what I'm talking about. It can be a pain in the ass, a lot of documentation, paperwork. They want to make sure you can pay it back. It's not to say that these companies don't vet, but they tend to go to smaller companies and companies that banks don't want to take, riskier companies. And one of the potential problems, if you read up on this, and I was even reading a letter by I think it was the Boston Fed, one of the Fed banks, is that they're usually financed, these private credit companies, will then take a revolving line of credit from a bank. So they're borrowing money from banks and then turning around and lending into these loans. And just like private equity, it's not a problem if you're a private equity company or a private equity investor, until it is. And it's kind of almost like the Ponzi scheme thing. It's that the fact that private equity companies get to value their assets because they're not publicly traded. And so they can kind of do what we call it mark to fantasy in the accounting world. It's supposed to be mark to market. Publicly traded assets every day, every minute. There's stringent reporting requirements. That's what these quarterly earning reports you hear about are. You can dig through there. Companies have to disclose, show their books. Yeah, they can cook things and move things around with little accounting gimmicks, but for the most part, unless it's outright fraud like Enron was, and every now and then that's uncovered, there's transparency, and more so a lot of trading in those publicly traded stocks, companies, and even the fixed income market, bonds. But those private equity companies, so when things drop, they don't have to right away recognize. Again, it's up to the fund managers and private equity companies and the private credit companies to say what they think their equity investment holdings, or in this case, loans, are worth. And so again, that may be a good thing because people don't panic out during, good examples when the markets tanked earlier this year. That's a good example right there, that you don't initially see that huge drawdown in valuations. But it can be a problem, especially if the longer it goes on, that they use these, in some cases, tremendously overvalued valuations. In other words, they have an asset, the company's kind of heading in the wrong direction, heading south, but they keep pricing it at 90, a dollar or 90 cents on the dollar or 80 cents on the dollar on the books, when it really should be worth, if it was traded in the publicly traded markets with more visibility, that paper might be worth 50 cents or 30 cents on the dollar. So we'll see. Again, there's a lot written about this. And the problem too, not only can some of these private credit companies blow up due to that, and I'm watching them, and that's the clearest way. There was a few years back, it was 10, 15 years ago on this site, I pointed out, I watched the brokers close. I watch a lot of stuff all the time. I don't always bring it up to you guys. I watch broker dealers, and if the sector's going up, and most broker dealers are going up, and that's fine. But if you see one all of a sudden starting to head in the other direction, south, something's going on. Same thing with regional banks, bigger banks, and I look for those kind of tells. And so I'm watching, and there's a couple of these that are heading south. I'll go over these real quick here. So where I'm going again, back to my point, is that if there's some problems there, if they've been overstating valuations for a long time on some of these loans, it's not only going to be a problem for some of these companies, it would also be a problem potentially, and again, this is written by various articles, for the bigger banks who have lines of credit out to these companies, because if one day they just come and say, poof, we lost a lot more than we thought, and things can happen fast in the financial markets, then they default on the loans, those lines of credits that they have to the banks, with the banks who are funding these companies, who then take that money and turn around and lend it out to, again, in some cases they might be decent credit quality companies. But again, if you read about it, and again, if you read about it, a lot of it's unknown. They don't know, because that's the big problem with both private credit and private equity, is that they're not publicly traded, and the companies they're buying aren't, so they don't have to file quarterly earnings reports and open their books up like that. All right, so what I have is, these are some of the biggest ones, just so you can get an idea. And you might want to keep an eye on some of these too. This is Blackstone Secured Lending Fund. And one thing I'm noting here is that unlike the stock market, which is at or near all-time highs, a lot of these aren't. And so again, I'm seeing, I'm watching this, and you can see my support levels. This one is right at support now. This is one of the biggest ones, by the way. If not, this is I think the second largest at 7.1 billion. And it's right at a key support level now. Next support, let me move it over right here if you want to replicate the chart, 2009. This is where it went during the big drop back in April, and those are all key levels to watch. Now, technically speaking, it's at support. Normally, I might say, yeah, look, you can make a case to buy it here anytime anything falls down to support, especially big drop. This is just in the last, what is this, the last couple week or two here. This has dropped 8%. Nothing horrible, but why is that happening when the market's at all-time highs or right off all-time highs, right? Concerning. Next level there, next level there. So I'm going to continue to watch these, and I'm going to rifle through some of them real quick, just show you that a lot of them are off their highs, breaking trend lines recently, starting to go down. But you can see my support levels. This is the ARCC, that's Ares Capital, ODBC, Blue Owl Capital. There's the chart. There's the levels there. KKR Capital, FS, the symbol is FSK. One of the biggest, this is 5.6 billion. So I put little blue flags by the biggest ones. This is from one of the articles I got. And then I pulled Perplexity Pro and I did a search to show me all publicly traded business development companies in the US, and that's this list that I have here. There's a few ETFs in here that track them, by the way. I just want to share that. So instead of me going through each and every one, and again, the thing is, just some look better than others. Some are really here. Let me just go down here and show you what's happening today on some of the, some of these are just been moving down there in big bear markets. And this one, again, I just showed you, take it on the chin. I don't have, there were a couple that stood out and I just don't have them flagged right now. I just flagged them by the biggest ones. But let me show you an ETF, one of many if you want to kind of keep an eye on the sector yourself and you don't want to have to replicate a list. It took me about probably 30 minutes to get that list together. BIZD is one of several market vectors, BDC income ETF, right at support right now. Pretty good support, and you can see it's kind of moving sideways for the last couple of years. But if that support level goes on the weekly chart, I have it coming all the way back down here, which will test the April lows, and that's going to show some pretty severe distress. Remember, everybody thought the world was falling in henny penny, chicken little, in the equity markets, that is, and the fixed income markets. We were short off the highs, but we were covering at that lows for the same reason. I said it was overdone, overblown. The Trump, as arrogant as he is, he's not going to let the world come to an end and keep 200% tariffs with China. I give you my word, they're going to back down, and stuff will get worked out. And this is an overreaction, and it was. But if we get down there now, if the credit markets get down there again, or at least this aspect of the credit markets, that's going to be a bad sign. And that's major support. You can see a test of the 2023 lows right there. Right after that's where the last bear market ended in October of 2022. So really big levels to watch here, guys. And, if the market's going to continue on and go to new highs and beyond, then it would help to see this sector. And I have a few other ETFs in here as well. I'll watch them all. It would help to see this sector go up. So that's it. I just want to throw that out there for those of you that do monitor credit spreads like I do, and know that I think, for forever and a day, a lot of folks, that's all we looked at. We looked at, the charts. You can get them from any of the Federal Reserve Banks, credit spreads. There's various ones out there, and they've been really tight lately. And, it's not just me. Jamie Dimon himself has been warning of this and the fact that credit spreads are not pricing in the risk that's out there right now. And again, I think that they're artificially compressed or low right now. And so, but that's it. As long as the music keeps playing, it's this market's like a game of musical chairs. That's what a bull market with a strong bid is. And as equity prices go higher in the stock market, consumer confidence goes up, especially if the real estate market holds up. We know that's already seemed to have turned. But if this starts going down, then you will see consumer confidence go down in line with it, and pretty much an accelerating rate. And so it's all ties in together. Watch the jobs market, continue to watch that. Watch the stock market, of course. and we'll watch these. And I might have some trade ideas for you in this sector. I'll throw them out to you later on. And that's about it. I told you lately, you know, I'm not red hot on the grains, but you know, you can't pass that up. That wheat finally just broke out of that near-term price channel and put in another marginal new and still divergent low. And by the way, you know, remember, I've been highlighting wheat for a while now. It's at long-term support that goes back for a decade, a long-term, multi-decade long uptrend line. In this divergent low here, although it also shows right here on this, I don't know where it was. I thought I had it in the chart I gave you today. If not, that's your current divergent line right here, divergence line from that point right here with the indicators making higher lows. But it also carries back. This was a lower low, so this is really one big divergence. And the reason it spans the whole chart, because I'm only on a 6-month, 2-hour candlestick chart. You go to wheat, or if I zoomed out on wheat futures, same thing. You can see that divergence continues to build, gets bigger, bigger, bigger. And the long-term support I have is on my wheat futures chart on stock charts. I don't have that chart queued up, but I've shared it with you many times over the last few months. And so that's it. We're still there. Big, big divergence. And at some point, all trends do change. As you can see, you know, wheat's not one to go sideways for more than a couple years or so. Like most commodities, it's either going up or down. We're in a downtrend. So this one, trend change will come. And again, it's wheat. It's not, you know, the latest crypto meme coin or some penny stock that can declare Chapter 11 bankruptcy, and then it's worthless because the creditors step in, grab the assets, and the stockholders are left with nothing. This is wheat. The day humans stop eating is the day that you can short wheat down to zero. So in other words, it's going to find a floor, but it doesn't pay a dividend. So again, it's hard for me to get excited about it until they break out. So all we've had for the last year or so are these tactical, shorter-term trades that pop, you know, we pop, we get these, I'm going to the left of the chart here, divergent high. We had a long before that. That was T2 was hit right there. Put in divergent high, went down, corrected, put in a divergent low, another rally, another correction, divergent low, hit our first target on the last one, and we went down, and there's the breakout today that I showed you on the bearish, bullish falling wedge. Again, divergent low, divergent low, divergent low, wash, rinse, repeat. 1, 2, hopefully 3, and then one of these will be the one that sticks. But so far, that one had the potential. It didn't. That one had the potential because we're coming up on that long-term support back then, and we're still there now. So, all right, guys. I'll just wrap it up with the VIX. I promised you a short one. We'll just keep it short. And the VIX, as I told you the other day, did break out. We were coming off this divergent low. This is a daily chart. This is... we had a long entry there, hit our first, second target, expected a pullback because expected the market to rally, pull back more than I thought it would, but it's come full circle with the positive divergence there, at least on that PPO on the daily, slightly lower low on the RSI there, but we did break out of that downtrend line and we're back testing right now. So again, it's not an aggressive all-in moment. The market, they just seem to buy all these dips. So the levels that I gave you that I started out the video, if you're wondering if this breakout's going to stick, this breakout and backtest, which certainly has the potential, I want to say I think it will, but like I said, this market's showing resiliency we haven't seen in years. All that matters is if we take this level out, if we take that level out on SPY right there, 619.66, I believe the selling will accelerate. I think we'll drop pretty quickly down all the way. We'll probably have very little, if any, reaction on that 610.55 target. Probably go down to a 603.90 for the reasons I stated before, that thin zone in the volume price histogram. And that will most likely spike the VIX. But as I often say, support is support until unless broken. So you got to break that. If you go to a new high, is it going to change the outlook? By the fact that it's a new high, you'll still have negative divergence. I'll just take this line and go like that, or you know, this longer line back here. But that's it. So I still favor this. I give you some recent targets on QQQ, and you have long-term targets on SPY and all that. You have the upside targets on the VIX. Just got to be patient. Tops are often a process, bottoms can be an event. Bottoms, sometimes you get those big washout moves. Tops in certain markets, you can, usually in stocks, you can get a blow off top, a single big move up, parabolic run. But tops in the stock market are usually much more of a slow roll process, kind of like a tanker turning in the ocean, whereas bottoms can be a pretty quick event, more of a V situation than the tops. Like, remember that top there, we went sideways for months, and then that was my lights out level when that trading range was taken out in both SPY and QQQ. But we already had sell signals before that with minor trendline breaks and bearish and engulfing candles and all that. But so that's it. So right now, let's see if we can take out those recent lows and then get a good old-fashioned sell-off going, which we haven't seen forever and a day. Other than that, like I said, I'm just not comfortable chasing a lot of the longs that I'm giving you. I'm giving you quite a few recently, but they're just more like bottoming plays, minimal downside. There's not much hot air left out of them. They're heavily shorted in many cases, so your downside's more limited than jumping in a Palantir or NVIDIA, or we all saw what happened to SMCI the other day for those that chased that one into earnings. All right, I will stop it here. This has been Randy Finney with Right Side of the Chart. You have a great day.